Look around you. Prices aren't rising the way they did in 2022, but debt levels? They've quietly hit record highs in 2025. US federal debt now sits in the mid-$30 trillion range, with debt to GDP above 100%. That's the paradox Ray Dalio warned about, the calm before the real storm. This storm isn't abstract. It will hit your rent, your savings, and every paycheck you earn. In this video, we'll cut through the noise: debt, politics, technology, climate, and supply chains, 5 forces shaping 2025. And I'll give you 3 practical moves you can use this week to protect your spending power. It all begins with the debt iceberg we're standing on. The debt iceberg we're all standing on. Inflation has cooled from the chaos of a few years ago, but global debt has never been higher. While price levels make it seem as if the system has stabilized, the numbers behind the curtain tell another story. In the United States alone, federal debt now exceeds $34 trillion, and debt to GDP has climbed above 100%. Europe faces similar pressures, with entire economies carrying debt loads larger than what they can realistically produce over a decade. China tells the same story through different details. Growth has slowed, yet local governments continue borrowing heavily to support fragile real estate sectors and infrastructure promises. No matter the country, the outcome looks the same. Obligations have expanded far beyond what their economies can carry without consequence. The real danger is how this turns from an abstract government problem into a personal financial drain. When national debt swells, it doesn't simply exist on a ledger in Washington or Brussels. It reshapes the entire economy around it. The more governments borrow, the more they must spend servicing that debt. And in 2025, U.S. interest costs now rank among the 3 largest federal expenses, alongside programs like Social Security and defense. Every dollar sent to creditors is a dollar not going toward public services, infrastructure, or healthcare. That crowding out eventually makes its way to you in the form of higher taxes, new fees, weaker benefits, and slower economic growth. Put simply, higher national debt increases interest costs, and that reduces the capacity of governments to fund services, pushing more hidden costs onto citizens. You can see how this plays out in daily life. Imagine a young professional who started their career a few years back. At the time, they were earning around $45,000. Today, they've worked up to $78,000. On paper, that looks like progress. But the reality underneath feels anything but secure. Housing consumes most of their paycheck, healthcare premiums climb year after year, and energy bills now amount to the equivalent of another rent payment. Even with promotions, the things they need come with a heavier price tag, and the safety nets they rely on are thinning out. Their higher income means less than they expected, because debt obligations at the national level are quietly squeezing money out of every part of their budget. This squeeze is not the result of reckless households, but of governments leaning on borrowing they cannot afford. Leaders finance today's promises by issuing debt, then shift the repayment burden onto workers over time. Taxes inch higher, often through smaller changes that don't make headlines but become noticeable when you file. Pension programs raise eligibility ages or lower their commitments. Cities add infrastructure fees to cover what federal budgets no longer support. Year by year, benefits shrink and contributions increase. Not because of poor personal choices, but because the system is redirecting the hidden cost of debt back onto citizens. The treadmill effect sets in. People run faster, but the ground is tilted against them. Across the globe, the picture looks strikingly similar. American politicians debate endlessly over military spending and entitlement programs. European governments argue about maintaining pensions while constrained by Brussels. Chinese officials fuel short-term growth by propping up construction and state-owned firms. Each region dresses its borrowing in different words, but the mechanism is identical. Debt today, consequences later. The problem is that later has already started arriving. For everyday workers, the math creates disillusionment. Someone might be earning more dollars, euros, or yuan than ever before, but their wealth slips away through cracks built into the system. They wonder why promotions don't translate into greater independence, why side hustles barely move the needle, why their parents could buy homes and save for retirement on modest incomes while they struggle despite higher paychecks. The answer circles back to the same force. Government debt is expanding in ways that reduce the breathing room individuals once had. The iceberg metaphor illustrates the danger. The visible numbers, the reported inflation rate, the rise in Nominal salaries seem manageable, but below the surface sits a vast mass of obligations, hidden but threatening. You don't feel it daily until the collision happens, when the lack of funding for schools, roads, or hospitals becomes unavoidable, or when the cost of borrowing for a home or small business suddenly spikes. Debt doesn't announce itself before it erases stability, which is why it's often ignored until the damage is already done. This isn't just about accounting sheets or debates in Parliament. It's about whether the foundation of daily economic life holds or cracks. When governments owe too much, interest demands eat up more space in the budget. Services thin out, loans cost more, wages lag behind. Citizens pay for it in ways subtle and obvious, whether it's a disappearing tax refund, a downgraded healthcare plan, or the inability to save for retirement. Unlike personal debt, which you choose, national debt is imposed. Ordinary citizens inherit the costs of promises they never signed off on. And while borrowing patterns seem like distant, abstract fights between parties and ideologies, the consequences add weight to every household budget. People end up footing the bill for obligations that stretch back decades, carrying expenses that governments have quietly shifted onto them. That is the iceberg hidden beneath calm waters in 2025. Not reckless consumer spending, but a national and global reliance on debt that keeps passing the cost into the future. Yet the growing financial burden isn't fueled by economics alone. The choices that keep debt climbing also emerge from deeper divisions in society, the conflicts that make structural fixes politically impossible. Before long, those divisions add another, less visible expense, an economic tax paid not in dollars and cents, but in the uncertainty that paralyzes progress. Political polarization, the hidden economic tax. Wages aren't the only pressure point in 2025. Political polarization has become its own form of economic burden, less obvious than inflation reports or budget deficits, but equally powerful in shaping financial reality. In economic terms, polarization functions like friction in the system. It delays decisions, discourages investment, and makes each policy adjustment costlier than it should be. Unlike formal taxes that appear clearly on a paycheck stub, this hidden levy shows up as higher borrowing costs, muted confidence, and stalled opportunities. People pay the price directly, even though it never appears on a government revenue line. A key way this cost emerges is through confidence channels. Investors dislike uncertainty, and when political divisions dominate headlines, the environment looks unstable. In these conditions, businesses often delay long-term projects, preferring to hold reserves rather than commit to expansion. That defensive stance trickles downward. Fewer new jobs, paused infrastructure projects, and stricter lending standards across the economy. In the United States, gridlock between political parties over fiscal questions has become a recurring theme. Each unresolved battle signals to credit markets that governance is unpredictable. Ratings agencies respond by noting higher risks, and bond markets demand greater yields to absorb uncertainty. For governments, that means increased interest payments. For citizens, it means fewer resources devoted to services, higher everyday borrowing costs, and a weaker economic foundation overall. Research also highlights another layer. When political divisions run deep, even institutions like central banks face scrutiny or interference. That loss of independence can rattle investors, raising additional risk premiums on government debt. The point isn't partisan, it's structural. Markets perceive political risk as financial risk. When that perception grows, it translates into tangible costs for everyone from homebuyers to small business owners looking for loans. Higher yields at the government level spread into higher lending spreads at the household level. The mechanism is subtle but direct. Political fights filter into markets, and markets adjust by raising costs. Citizens then shoulder that adjustment. Europe faces its own gridlock dynamic. Governments there grapple with aging populations and the rising cost of pensions. Economists broadly agree reforms are needed, but polarization between parties prevents action. Political leaders often choose stalling over compromise, pushing decisions into the future while deficits widen. Bond investors factor in the indecision, and yields creep upward. This cycle becomes a hidden tax on the public. The same citizens waiting for resolved pension policies instead watch government budgets pay more for borrowing, leaving fewer funds for public services. The drain is quiet but steady. One flashpoint in multiple countries is wage legislation. In the US and overseas, debates about minimum wage reform carry major symbolic weight. Advocates emphasize the need to lift stagnant real wages, while critics warn against extra costs for small businesses and inflation risks. But instead of compromise, the argument lingers unresolved. Businesses hold back on planning because they cannot forecast labor expenses. Employees wait for improvements that never arrive. Consumers eventually bear the burden in weaker growth and fewer opportunities. What could be a clear policy intervention instead mutates into uncertainty, a cost generated not by the substance of a decision, but by the lack of one. Tax reform tells a similar story. Many leaders on both sides admit current codes are outdated, filled with loopholes that allow large companies to minimize obligations. Average earners shoulder disproportionate costs, while structural fixes stall. Compromise positions exist, but parties refuse to move. While officials spar, deficits mount, requiring additional borrowing, often at higher yields, because markets read the inaction as instability. That higher-cost borrowing isn't absorbed by politicians while in office. Instead, it filters down as inflationary pressure, elevated interest expenses, and weakened government services. Government shutdown threats remain another symbol of dysfunction. Each time the possibility surfaces, federal agencies prepare for disruption, households dependent on public salaries tighten budgets, and contractors hold off on commitments. Even when shutdowns are avoided at the last moment, the perception of instability lingers. Businesses report halting expansion plans, fearing a sudden funding freeze. Local economies feel the drag as consumer spending slows. Investors reposition funds towards safer assets, pulling capital from stock and bond markets. The slowdown isn't headline-grabbing but visibly limits growth potential. Wages stagnate, capital dries up, and productivity gains are delayed. That opportunity loss becomes another hidden cost acutely felt by citizens. International observers respond to these same signals. Research shows that when political dysfunction dominates, outside investors demand higher compensation for risk when lending to that country. That translates into higher sovereign yields and eventually higher credit costs across society. It doesn't appear as a classic tax, but from the perspective of an individual needing a mortgage or small business loan, the reality is identical. The cost of borrowing is higher due to political breakdowns. Some corporate leaders have described this climate as one where speaking out against policy risks political backlash. Reports from business surveys indicate muted sentiment, with executives delaying major decisions because they cannot confidently predict the direction of fiscal or regulatory policy. This hesitation at the boardroom level ripples across recruitment, capital allocation, and hiring, making polarization not just a debate in Parliament, but a line item in corporate risk assessments. The deeper irony is that these hidden costs strike hardest at individuals who feel removed from politics. Young workers entering the job market encounter slower hiring cycles because firms hesitate under uncertainty. Infrastructure upgrades drag out for years as legislation stalls, meaning communities miss the efficiency benefits new projects could provide. Borrowing costs for everyday loans climb as political dysfunction filters through bond markets. These are not abstract effects. They shape the daily math of budgeting for rent, car payments, or education. How this affects you right now is straightforward. Firms postpone hiring decisions, public projects stall before breaking ground, and households face more expensive loans. These are three immediate consequences of political polarization that turn abstract disagreements into lived experiences. You don't need to follow every vote in Parliament to feel its impact in your daily expenses and opportunities. This interplay between politics and economics matters because once confidence erodes inside a system, costs rise everywhere else. And while political division feels like an internal struggle, its effects radiate outward. Polarization weakens economic foundations, and that weakness leaves countries more exposed to outside rivalry. That rivalry is already shaping the global balance in areas far more critical than fiscal policy. Areas where competition will determine who sets the rules of trade, capital flows, and innovation in the years ahead. The US-China tech war has escalated. Technology is no longer about new devices or faster networks. It has become a front line of national security. In 2025, the US-China tech war has escalated into a struggle that defines economic and strategic power. At its center are semiconductors and artificial intelligence, industries where dominance can determine not just corporate profits, but the strength of militaries, supply chains, and currencies. What began as a competition for market share now looks more like an arms race, with both sides racing to secure technologies that grant leverage far beyond the tech sector. China has narrowed some of the gaps in chipmaking, but despite advances, it still trails at the cutting edge. While domestic firms have improved fabrication processes and built momentum across mid-range nodes, access to the most advanced tools remains restricted. Beijing continues to pour money into research, talent development, and local ecosystems, aiming to reduce reliance on imports that can be severed in a political confrontation. Meanwhile, Washington has widened its export controls, tightening limits on high-performance semiconductors and the specialized equipment used to manufacture them. Companies like NVIDIA now find themselves at the center of high-profile licensing debates, as regulators weigh whether advanced GPUs should fall under expanded restrictions. Each policy announcement carries consequences not just for governments, but for businesses and consumers worldwide. The back and forth has added new strain to the global supply chain. Electronics are no longer treated as luxury goods with incremental price increases each product cycle. They are now strategic assets, and that has transformed the economics around them. Costs for laptops, phones, and even the sensors embedded in farm equipment and vehicles have climbed, not only from production expenses, but from the friction of geopolitical maneuvering. Washington's restrictions on advanced chip exports ripple through consumer markets, and Beijing counters by accelerating its state-backed investment programs. The net result is felt at the checkout counter. Higher costs for everything from diagnostic machines in hospitals to the microcontrollers that regulate heating systems in homes. Consumers may not hear the details of licensing disputes or embargoes, but the effects show up in their bills. This is about more than electronics. US tariffs and Chinese retaliation have helped push prices higher across categories ordinary households depend on. Clothing, furniture, and household appliances all have seen inflation pressure that economists trace back to trade and tariff dynamics, not consumer demand. Major news outlets in recent months have linked part of goods inflation directly to these shifts, reminding households that the tech war is not an abstract contest. It directly influences the sticker prices in everyday life. The role of artificial intelligence adds another layer of complexity. Both nations are racing to embed AI into commercial and military systems, and the line between those two uses has blurred. An algorithm that streamlines factory logistics can also highlight attack points in a rival's infrastructure. A drone guidance chip designed for agricultural monitoring could just as easily guide autonomous weapons. The dual-use nature of AI means each breakthrough carries strategic implications. For individuals outside government or research labs, the more visible effects show up in two areas: prices and volatility. Electronics cost more, and markets swing more sharply as investors assess policy signals instead of consumer demand trends. That new volatility is difficult to ignore. In today's market, valuations for major chipmakers and tool suppliers shift instantly with updates from Washington or Beijing. Investors track meetings, export rules, and subsidy announcements as closely as earnings reports because those policy signals drive stock performance. A single announcement on GPU licenses or export curbs can wipe billions from index values overnight. Ordinary retirement accounts and mutual funds increasingly absorb this volatility, tying household wealth to geopolitical decisions rather than basic business cycles. The ripple effect extends well beyond Wall Street. Nations with critical roles in chip supply chains, Taiwan, South Korea, and the Netherlands, face heightened pressure as both China and the US seek to secure their cooperation. A photolithography system shipped from Europe carries implications measured not just in dollars, but in strategy. As alliances adjust, smaller countries with advanced manufacturing capacity now wield disproportionate influence, shaping the balance of power with each trade agreement or hardware transfer. Chip technology has overtaken oil and steel as the foundation around which global positioning orbits. For consumers, the fracture is already visible. The global tech market is splitting into parallel systems. Products designed for American-aligned markets are diverging from those built for Chinese ecosystems. Some devices launch only in specific regions, while others appear stripped of functions depending on location. Cross-compatibility, once taken for granted in the digital economy, is shrinking. Imagine downloading an app in Shanghai that runs seamlessly there, but is unusable in Los Angeles, or buying a device in California whose software is barred in Beijing. These developments reshape consumer choice. not because of engineering limits, but because geopolitical borders are being redrawn within technology itself. The bigger picture comes into focus when considering how much influence these technologies carry across sectors. Finance, transportation, energy, healthcare. Each industry runs increasingly on artificial intelligence and chips. The nation that secures a long-term edge doesn't just sell more electronics. It writes the standards, controls market access, and consolidates global dependencies. With industries ranging from payment systems to power grids dependent on advanced silicon, technological leadership now translates directly into financial leverage and strategic bargaining power. Military capacity and currency standing are no longer separable from computing capabilities. This is why the US-China tech war has escalated into one of the defining economic events of the decade. Citizens experience it less through speeches or media headlines than through direct friction in their daily lives. Higher costs for household goods, delayed releases for gadgets, blocked apps, and region-specific product lines all reflect the new reality. Investors experience it through unpredictable swings that don't line up with fundamentals, but rather with policy announcements. And industries across the globe feel its pull as global wealth shifts, less by demand and more by regulatory maneuver. For those with exposure to technology stocks or supply chain industries, awareness is critical. Watching policy signals and recognizing where bottlenecks lie, in chipmakers, in tool suppliers, in export rules, has become as important as traditional diligence on earnings or margins. Even investors who hold diversified mutual funds are linked to these moves, since technology now anchors so much of the global economy. Practically, this suggests adopting a more defensive posture. Check how exposed you are to single supply chain choke points and pay attention not just to market data, but to policy headlines. In 2025, control over silicon is shaping markets, trade balances, and balance sheets alike. But while the tech war remaps industries and raises costs, it is not the only unexpected force pressing on household budgets. Another set of pressures comes not from boardrooms or export controls, but from outside the realm of politics entirely. Acts of nature, climate, energy, and your grocery bill. Prices for food and energy in 2025 are increasingly shaped by forces that policy can't easily control. Climate shocks, droughts, floods, and severe weather are no longer occasional disruptions. They are now persistent drivers of volatility that hit consumers where it matters most: the grocery store and the utility bill. The effects are immediate and felt unevenly, which makes ordinary shopping expenses unpredictable even when official inflation data looks stable. Case in point, Consumer Price Index figures ticked up to roughly 2.9% in August 2025, with economists pointing to tariffs and weather-related supply disruptions as part of the reason goods inflation stubbornly lingers. In some ways, bread has become the most visible example. Prices for flour and bread products have climbed sharply despite headlines suggesting inflation has calmed. The underlying reason has little to do with monetary policy and everything to do with climate. Drought across major grain-producing regions cut yields sharply, while destructive floods blocked transport routes that would normally carry surplus supply to international markets. The outcome is a straightforward mismatch. Supply falls, demand stays consistent, and prices move up. For a household trying to plan the week's groceries, the explanation doesn't matter as much as the reality. They are paying more no matter what the central bank says about inflation trends. Energy mirrors this volatility. Heat waves increase electricity demand to levels that strain power grids, forcing utilities to switch on more expensive backup generation. Severe storms disrupt oil and gas shipping channels, throwing fuel markets into sudden spikes. Import-dependent economies feel these shocks hardest, but even in wealthy nations the impact lands quickly. Utility bills arrive higher than expected and factories pass along greater costs in finished goods. These shifts highlight a structural point. Central banks can't grow crops or rebuild ports. When disruptions are environmental in nature, solutions require fiscal choices, infrastructure upgrades, and supply chain adaptation rather than just adjusting interest rates. Supply chains make the problem even more noticeable. While countries have spent years trying to diversify, much of the global food and energy system still depends on long-distance trade. When climate events hit, those networks reveal their fragility. Take a familiar pattern. Drought reduces grain harvests, which in turn makes animal feed more expensive. Months later, The added feed cost shows up in higher meat and dairy prices at the supermarket. A single weather event spreads through multiple stages of the food chain, stacking pressures along the way. For families, this creates a sense of financial instability. Chicken might be affordable one month and noticeably higher the next, with little explanation in the news. Bread or milk absorbs a bigger portion of weekly income, even in months where the national inflation rate appears stable. This irregularity frustrates ordinary planning, because standard budgeting tools assume gradual shifts, not sudden swings triggered by an early seasonal frost or a flood halfway across the world. Governments attempt to respond with subsidies or by releasing grain reserves, but those interventions are temporary and leave structural fragility intact. The most punishing part is how these climate-linked costs build on one another. A poor harvest raises prices directly for grains. At the same time, it makes related goods, livestock, dairy, more expensive down the line. Add a flood in the same year, and supply routes clog, amplifying costs further. When extreme heat follows, energy bills surge just when households are least prepared. Every stage compounds the original shock. The result isn't just higher prices, but a layered squeeze that makes disposable income feel perpetually thinner. Planning for savings, retirement contributions, or education funds becomes much harder when the grocery bill alone keeps absorbing more space in the budget. The economy absorbs these impacts unevenly. Wealthier households or regions with modern infrastructure absorb shocks more easily. Poorer communities without robust transport links or storage capacity suffer more prolonged shortages. That uneven burden translates into inequality. Two families with similar wages and jobs can experience very different living standards depending purely on whether climate disruptions hit their region this year. This geographic lottery reinforces disparities that monetary and fiscal policy aren't nimble enough to correct in real time. Even major companies struggle. Traditionally, corporations offset risk through geographically diverse supply networks. But when climate events occur in multiple regions simultaneously, insurance costs increase and reserves thin quickly. Some companies raise prices directly on consumers, others delay investment projects, or hiring to hold on to liquidity. In all cases, volatility dampens growth. Individuals feel it not just in higher food and energy bills, but also in fewer career paths, smaller pay increases, and diminished job security. Climate-linked volatility becomes both a direct and indirect cost every worker must carry. Governments frame their actions as short-term stabilization. Some release strategic reserves of food staples. Others apply subsidies to temporarily reduce energy prices during heat waves or cold snaps. But these measures stress public budgets already strained in the debt-heavy environment of 2025. Officials promise such spikes are temporary, pointing to future harvests or milder seasons ahead. Citizens, on the other hand, recognize that disasters are more frequent, not less. Each time relief programs are rolled out, they sense the government is reacting to a permanent shift with patches rather than long-term adaptation. For households, the key question becomes, how do you plan for volatility when patterns no longer follow historic cycles? Traditional economic ups and downs are relatively predictable. Recessions and recoveries follow statistical signals that analysts can at least forecast. Climate-linked disruptions break this model. They arrive irregularly, vary in severity, and ignore conventional timelines. That makes household planning more difficult, not just for big expenses, but for basics like weekly groceries or monthly utilities. Viewers watching closely can take a few practical steps. For groceries and energy costs, building a modest buffer helps smooth sudden price jumps. Stockpiling staple foods in bulk when prices dip reduces vulnerability later. Improving household energy efficiency, whether through insulation, LED lighting, or smart thermostats, cuts the impact of sudden shocks in power prices. I recommend every household keep at least a one-week emergency food supply and prioritize high-yield savings accounts specifically for covering near-term spikes. These aren't full solutions to the systemic risks, but they give individuals more resilience in day-to-day finances. Seen in this way, climate has become a participant in the economy as much as any central bank or finance ministry. It doesn't legislate, but it constantly reshapes economic conditions through floods, heat waves, and drought. Officials admit they can't manage these costs with monetary tools alone, acknowledging the structural shift citizens already feel. Families and communities adapt because they must, embracing strategies that may have seemed excessive in the past, but are now essential. The broader truth is that economic security in 2025 rests as much on environmental resilience as it does on fiscal discipline. A single storm or drought has the power to undo the most careful personal planning by driving up food and energy costs in a single season. Families are discovering that the central inflation question is no longer whether the rate is 2% or 4%. It's whether unexpected weather will push next month's dinner or utility bill far beyond expectations. And while nature exerts these pressures through volatility, a different kind of force is reshaping the economy through innovation. Instead of destroying harvests or breaking ports, it is rewriting how markets create wealth and how jobs survive in the first place. Technology's double-edged sword. Technology's influence has never been more contradictory than it is in 2025. Artificial intelligence carries two distinct outcomes at once: rapid wealth creation for some and widespread job insecurity for others. On one side, AI platforms, automated services, and algorithm-driven funds are generating fortunes in months. On the other, those same systems are rendering roles in offices, factories, and customer service obsolete, leaving millions uncertain about their economic security. This duality defines AI today, a powerful engine for growth that also acts as a sharp disruptor of livelihoods. The effect is visible in market composition. Technology stocks dominate indexes, buoyed by corporations that integrated AI into logistics, consumer prediction, and operations. These businesses scale faster, attract investors, and cut costs in ways their competitors cannot match. Markets respond predictably. Valuations surge, funding flows to AI-led ventures, and capital rewards efficiency above all else. But efficiency often translates into fewer workers. Occupations once considered stable are shrinking. Data entry clerks, call center representatives, and administrative roles are now largely managed by algorithms and chatbots. Research suggests nearly 25% of labor tasks in advanced economies could be automated with existing technology. Importantly, this figure refers to tasks rather than entire jobs, but it highlights the scope of transformation. Nearly every profession now shares work with machines. The divide between winners and losers often comes down to skill level. A senior engineer developing new AI models sees unprecedented demand and rising salaries, courted by firms across borders. In contrast, a customer support agent finds their role absorbed by software capable of handling thousands of queries around the clock. In manufacturing, robotic systems no longer just mimic workers. They redefine efficiency standards so that human mistakes or delays are unacceptable. The transition is not gradual, it is immediate. Entire categories of work are dissolving faster than education systems can redesign training pipelines. The mechanism behind this can be boiled down into a simple sequence. AI drives productivity. Productivity funnels profits and market gains toward those who own the intellectual property or deploy it effectively. Wealth concentrates at the top. Routine or support roles are displaced. The cycle repeats as scale improves. From a macro perspective, this is economic progress. From a household perspective, it's a widening gap between those who capture the gains and those left treading water. The result is wealth inequality intensifying even within advanced economies. Output per worker rises, but rewards skew heavily toward investors, entrepreneurs, and specialized technical experts. Wage growth at the middle and lower end struggles to keep up, while housing, healthcare, and higher education costs rise alongside new wealth. Families without equity exposure or in-demand skills watch opportunity erode, even though they live in economies producing record levels of value. Governments have acknowledged the problem, but struggle to respond effectively. Retraining programs have been rolled out across multiple countries, promising displaced workers new pathways in data science, programming, or digital services. In practice, these programs lag behind change. By the time a worker completes training, the target industry may already have adopted a newer version of the same tools or shifted altogether. This lag breeds frustration. Workers reskill at personal expense, only to see their new field quickly automated. Corporations have mirrored this challenge, funding internal reskilling programs that sound promising in announcements, yet produce uneven results. Surveys consistently highlight the gap. Interest in reskilling is high, but alignment with market demand is weak. The pace of technological cycles outstrips institutional adaptation. Financial markets remain clear in their judgment. Firms that optimize AI attract investment and expand aggressively. Startups demonstrating a credible AI strategy raise capital faster than peers, sometimes without long track records. In contrast, businesses resisting automation lose competitiveness year by year. Even sectors once thought secure, healthcare diagnostics, legal research, marketing, are now exposed. Generative models threaten to replace layers of white-collar activity that were previously assumed too complex to automate. Each new tool compresses workforces further, pushing more costs and risks back onto individuals. For households, adaptation is no longer optional. Some people pivot proactively, aligning their skills with AI rather than against it. Professionals who master AI plus domain expertise find themselves commanding greater value. A doctor versed in diagnostic AI systems, or an attorney leveraging legal research models, demonstrates why hybrid skill sets are rising in demand. These roles do not resist automation, they integrate it, making human expertise more effective. For others, adaptation takes entrepreneurial forms. People launch side ventures where human presence, cultural nuance, or creative work still hold an advantage. A local business informed by AI but dependent on relationships can thrive where mass automation cannot fully replicate the touch of ownership. The contrast creates a personal fork for every worker. One path views AI as augmentation, building careers and investments around systems that expand their abilities. The other path treats AI only as competition, leading to shrinking opportunities and weaker bargaining power. In prior industrial shifts, workers often expected to retire before automation transformed their entire profession. That assumption no longer holds. A 40-year-old professional may experience not one but multiple technological disruptions within their career span. Each requires renewed adaptation. Younger workers face an even starker reality. Stability no longer comes from merely choosing the right field, but from cultivating the ability to adapt horizontally across industries. A marketer must understand AI-powered data modeling, not just advertising strategy. An engineer must direct AI systems in addition to coding routines. An investor must separate genuine AI-driven value from hype cycles that inflate valuations. For students and early career professionals, the skill gap emerges within years, not decades, and determining whether to align with the shift or resist it shapes financial futures profoundly. Outside of white-collar work, adaptation still matters. Service roles grounded in community, care, or creativity remain harder to replicate. Entrepreneurs who use AI for leverage, managing bookings, advertising, or supply logistics, without trying to compete against it directly, occupy spaces where value persists. Households that diversify income through flexible, locally rooted ventures reduce risk compared to those relying solely on conventional employment. The common thread is the same. Protection comes through alignment with, not isolation from, technological systems. The wealth gains at the top illustrate the stakes. Families that invested early in AI-focused funds or major semiconductor firms have seen outsized returns. Retail investors can now access the same industries through ETFs and platforms that once favored institutions. The divide is not solely about rich versus poor. It is about whether individuals choose to engage with the technological wave. Inaction means exclusion, even as average wages stagnate and living costs increase. The lesson is not that AI will enrich everyone equally or strip everyone of work. The results hinge on positioning. Leaning on roles, AI replicates invites displacement. Cultivating rare, integrated skill sets provides resiliency. For audiences today, that means prioritizing combinations, like healthcare with AI literacy or finance with data science fluency, that pair human judgment with machine scale. Think in terms of AI plus domain, not domain alone. That pairing is less promise than precaution, a way to guard against obsolescence while capturing upside. Technology has become the most visible double-edged sword of 2025, shaping wealth and work simultaneously. And while AI forces individuals to adapt at the career and investment level, it is not the only frontier where old systems are colliding with innovation. A parallel experiment in money itself is unfolding, one that raises similarly fundamental questions about power, participation, and economic security. The role of cryptocurrency in the new order. Cryptocurrency has moved from the edges of finance to a place where it now shapes debates over money itself. In 2025, it is no longer realistic to describe crypto as a fringe speculation. It hasn't replaced fiat currencies in daily life. Salaries still arrive in dollars, euros, and renminbi, but it has secured a role as a hedge and as a tool for moving capital outside of traditional systems. That distinction matters. Coffee shops still won't take rent in Ethereum, but remittances, portfolio hedges, and emergency transactions often do flow through crypto rails. For ordinary people, the key shift is not seeing crypto as the future of money, but as part of the financial system that already coexists with fiat. Stablecoins are the clearest sign of this shift. At the start of this year, US dollar-backed stablecoins in circulation reached the scale of hundreds of billions, with estimates around $200 billion according to industry tracking. That size makes them impossible to dismiss as minor instruments. Stablecoins now carry as much weight as entire national money supplies. For businesses, the appeal is efficiency. Settlements are faster, global transactions less reliant on banks, and accessibility higher. For individuals, the allure lies in storing value in a familiar unit, the US dollar, while escaping bottlenecks in traditional banking channels. Their very growth reinforces the idea that while crypto hasn't overtaken conventional systems, it is becoming a parallel structure people rely on for specific functions. At the same time, governments are not standing still. Central banks from China to the European Union have advanced pilot programs for central bank digital currencies, CBDCs. These efforts are not uniform or universal, but the policy direction is clear. Leaders stress efficiency and control. Instant payments, cheaper transfers, and a direct line into monetary policy implementation. Analysts, including reports from global payments networks, note the strategic benefit to governments. A viable CBDC could prevent private stablecoins from dominating the payment infrastructure while giving monetary authorities visibility into every transaction. The balance of convenience and control is obvious. For policymakers, CBDCs represent modernized management. For citizens, they force new questions about privacy, autonomy, and the boundary between personal savings and government oversight. These dual tracks, decentralized crypto and state-issued digital fiat, are not hypothetical but active forces now shaping the financial order. The philosophical line between them is stark. CBDCs function as an extension of the state. They promise to speed up stimulus, automate compliance checks, and make tax collection more efficient. But they also layer in unprecedented surveillance capacity. Decentralized cryptocurrencies, by contrast, thrive precisely because they resist those levers of control. They are not issued by decree. They cannot be inflated to balance debt. And as users in restrictive economies know, they create an escape hatch from capital controls. The clash between these models is already visible. Pilot CBDCs roll out, while in response, citizens in some countries increase their Bitcoin or stablecoin holdings as insurance against tighter capital oversight. For individuals, the result is not a world where crypto universally replaces money, but a world where holding some form of crypto has become common practice. In fragile economies with rising inflation, stablecoins are the first alternative to preserve purchasing power. In countries with banking restrictions, people rely on cryptocurrencies to move funds abroad or to receive remittances without high fees. In more stable economies, citizens may still prefer fiat for everyday use, but keep a share of digital assets as a hedge. Similar to how investors for decades allocated small slices of their portfolios to gold. The question has shifted from legitimacy to structure. People now ask, what proportion of my savings should be in digital assets, and which type makes sense for my exposure? Governments still anchor the backbone of money. Legal tender laws, taxation in fiat, and payroll dominance ensure that dollars, euros, and renminbi rule daily spending. This makes fiat structurally irreplaceable in the short term. But alongside that fiat system, households increasingly run a dual playbook. Transact in national currency, safeguard assets in parallel with digital instruments. The strategy resembles energy diversification. Most homes still draw power from the grid, but more people install solar panels as backup. The grid remains the primary system. The backup creates resilience. Crypto operates in financial life the same way. When inflation hits or political risk rises, citizens with digital holdings avoid being completely vulnerable. The behavior of crypto markets has shifted accordingly. A few years ago, price swings often stemmed from speculation, meme culture, or sudden hype cycles. Those forces remain, but adoption has created more durable demand curves. Stablecoins pegged to fiat now represent a large and stable share of the market. Bitcoin and Ethereum continue to fluctuate, but portfolios no longer treat them as exotic. They sit alongside stocks, gold, bonds, and real estate in asset allocation. Even institutional players who once resisted crypto now publicly acknowledge its role. Pension funds and asset managers may keep exposure limited, but exclusion no longer defines strategy. Access and balance do. The broader takeaway is that the US dollar is still the primary global currency, but it no longer operates without competition. Its dominance exists within a layered system that includes digital hedges as pressure valves. Crypto has not dethroned fiat. It has carved out a permanent alternative rail that individuals use precisely where fiat is weakest: cross-border payments, capital restriction avoidance, and inflation defense. This isn't a revolution that swept away old money. It is more like an annex added to the House of Finance, where millions of people now live at least part of the time. For the average household, the pragmatic stance is not to overestimate crypto, but not to ignore it either. Some investors compare crypto allocation to precious metals. Ray Dalio, for instance, has argued for 10 to 15% of a portfolio in gold as insurance against systemic risk. Crypto today serves a similar role for some individuals. That doesn't mean overloading retirement accounts with speculative assets. It means treating digital coins as a measured hedge, modest in proportion but deliberate in design. The practical guidance: if you use them, they should remain a slice, not the whole pie, of personal financial protection. What makes this moment significant isn't crypto's ability to buy your morning coffee, but the way it has integrated into the balance of risk management. Stablecoins at a $200 billion scale show digital assets can achieve real size. CBDC pilots prove governments are recalibrating policy for a digital age. And households around the globe are making choices within this mix, allocating modest amounts toward digital hedges, even while fiat remains the foundation of their daily lives. All of this underscores a broader pattern in personal finance. Resilience is no longer about holding a single, stable asset. It's about layering defenses across systems, some controlled by governments, some operating outside them. For crypto, that means holding just enough to create optionality when systems falter, but not so much that volatility itself destabilizes your security. Everyday households in 2025 are quietly adopting that rule of thumb. They keep portfolios diversified, income stable, and savings partly shielded in assets beyond government reach. And that quiet diversification reflects the deeper concerns shaping financial choices today. People want tools that secure their future without locking them into rigid systems. In practice, that applies just as much to where and how they live as to which assets they hold. The financial order in 2025 is pressing households to re-examine not just their money, but the security of their most significant expense and their most culturally charged investment. Housing in 2025, shelter or trap. Housing in 2025 carries a sharper edge than in prior decades. For generations, owning a home represented stability, cultural status, even a financial rite of passage into the middle class. But today, that same decision can feel more like a precarious gamble than a sure step toward security. Mortgage rates remain elevated in the 6 to 7% range. While inventories have climbed, Realtor.com reports a roughly 20.9% year-over-year increase in August 2025. Those numbers shift the balance in ways ordinary families feel firsthand. Borrowing is costly, and even though more homes are on the market, demand hasn't returned in the same way. What once seemed universally safe now varies sharply by region, income level, and timing. For first-time buyers, the pressure is obvious. A decade ago, record low rates offset high sticker prices. Buyers stretched their budgets, confident steady appreciation would deliver gains later. In contrast, today's equation looks inverted. Debt service consumes more of monthly income, while the assumed upside of appreciation has weakened. In many urban centers, units that once triggered bidding wars now linger on the market, some even marked down from prior highs. Owners who bought into those markets at the peak face an uncomfortable truth. Their property may be worth less than the debt tied to it. Instead of wealth building, ownership can feel like locking savings inside an asset that refuses to grow. The story of one couple makes the trade-off clear. They bought a downtown condo in late 2023, stretching financially in the belief that prices would keep climbing. 2 years later, half their income goes to servicing the mortgage, yet the unit's market value has slipped below what they paid. Renting it out would not cover costs, selling would force a loss, and holding ties up capital that could have been put elsewhere. For them, ownership feels less like progress and more like paralysis. Renters, meanwhile, navigate the opposite side of the spectrum. The old stigma of throwing money away has lost some of its weight. While rents remain high, tenants avoid the burden of expensive, long-term debt tied to uncertain appreciation. In an economy defined by volatility and hybrid work, liquidity and geographic flexibility can be competitive advantages. Landlords may raise rents, but tenants can relocate more easily than owners burdened by immovable mortgages. In some cities where months of supply are rising toward buyer's market territory, renters stand to benefit further by waiting, observing market pressures play out before committing capital to ownership. This contrast underscores the unevenness of today's housing landscape. Some suburban markets still show brisk activity as families seek space and relative affordability. But the national pattern is fractured. Inventory growth is real, but it has not uniformly restored balance. Realtor.com notes some metros moving closer to buyers' markets in 2025, while others continue facing chronic shortages. That variability makes broad narratives about homeownership always paying off misleading. For younger buyers especially, the challenge is decision-making under uncertainty. The way forward is not repeating generational assumptions, but weighing 3 specific variables. 1. The mortgage rate environment. Rates remain elevated, shaping affordability more than list prices. 2. Local months of supply. Markets differ widely between oversupplied cities and undersupplied suburbs. 3. Personal liquidity. Maintaining a robust emergency fund and sufficient down payment buffer determines true readiness. Using those 3 metrics gives buyers a practical framework that relies on verifiable market signals rather than cultural expectations. Without that clarity, households risk overcommitting in a market that can stagnate for years. There are also straightforward tactics households can apply while they wait or reassess. One is moving cash into high-yield savings accounts or short-term CDs. With banks currently offering competitive annual percentage yields, money earmarked for a down payment or emergency reserve can earn returns instead of eroding against inflation. This step doesn't solve housing volatility, but ensures purchasing power is protected while decisions remain flexible. It also prevents the emotional rush into homeownership at unsustainable terms. For those who do decide to buy, strategy must be deliberate. Accelerating principal payments can reduce interest exposure over the long term, especially at today's higher borrowing costs. Owners can diversify income streams through partial rental, remote side work, or room-sharing platforms to offset monthly burdens. But these approaches only make sense when buy-in has already occurred. For prospective entrants, caution is stronger medicine. The most financially disciplined choice may be to wait, rent strategically, and preserve liquidity until conditions align more favorably. Renters also carry opportunities in their position. By calculating the difference between elevated mortgage payments and lower monthly rent, disciplined households can redirect the surplus into diversified investments. Over time, compounding in stocks, bonds, or even modest exposures to commodities and crypto can rival, or exceed, the equity accumulation they might have seen in a slow-growth property. Liquidity in volatile times is not lost equity. It can be deployed flexibly across markets that offer healthier returns. Mobility compounds this advantage. Renters in 2025 can chase job hubs, new industries, or more affordable regions faster than homeowners anchored by debt and uncertain property values. If an emerging tech corridor takes off, or if new infrastructure revives a regional economy, tenants can capitalize immediately. Owners watching their property stagnate in price while jobs migrate elsewhere have fewer options. In this climate, flexibility itself is wealth generating. The mental and cultural weight of housing remains, of course. Families still associate ownership with maturity and stability. For some, selling or avoiding purchase feels like giving up on that long-standing social marker. But numbers do not lie. In many metros, housing now behaves like any other cyclical asset, subject to debt cycles, demand swings, and global variables from rate policy to construction costs. Detaching identity from the investment is uncomfortable, but it allows households to recalibrate decisions with clearer eyes. The broader lesson is that shelter in 2025 can be either stabilizer or trap, depending on how it is handled. Ownership is no longer a guarantee of safe passive growth. Renting is no longer straightforward waste. Each carries trade-offs tied to credit costs, inventory dynamics, and regional factors. What counts as responsible now is not following inherited narratives, but aligning choices with economic conditions that exist today, not those of a decade ago. And that alignment matters, because the contradictions within housing are simply one piece of a larger environment where institutions, markets, and governments all appear less predictable than before. Individuals cannot control these larger forces, but they can control how they buffer themselves. That brings the question squarely back to personal finance. If everything around you carries more volatility, what steps can ordinary people take to strengthen their own position against it? Practical steps to financial resilience. If the housing market feels uncertain, the next question is how households can protect their finances more broadly. Practical steps matter here, because the systems around us may remain volatile for years. You can't stop rising debt levels, political gridlock, or climate shocks, but you can structure your own finances for resilience. And resilience isn't about predicting the exact timing of disruptions. It's about making sure disruption doesn't undo your stability. The foundation of practical resilience is liquidity. Having a 3 to 6 month emergency fund in a high-yield account shields households from being forced into credit card debt or predatory loans in a crisis. According to Investopedia, many top online savings accounts in 2025 still pay more than 4% APY, far above the near-zero average at big retail banks. Some families also keep part of their emergency reserves in short-term CDs. With inflation hovering around 2.7 to 2.9% this year, those accounts can actually keep pace with rising costs, while the big bank average rate erodes value. This step is tactical and accessible. It doesn't require expert timing, just consistency in saving until the fund is in place. Once a buffer exists, diversification becomes the next priority. For many, diversification gets reduced to owning both stocks and bonds, but in unstable periods it should extend beyond that. A balanced approach means spreading exposure across geographies, sectors, and even industries that are less correlated with one another. U.S. equities, international equities, government bonds, and corporate bonds can serve as the anchors, while modest exposure to hard assets such as gold provides a hedge against crisis periods. Experts often suggest that gold allocations stay small, not as a growth engine, but as an insurance layer during systemic stress. For households venturing into digital assets, a similar principle applies. Small, deliberate allocations to widely used tokens or stablecoins can add optionality in times of disruption. The key point with diversification is less about chasing the highest performing asset and more about making sure no single collapse takes down your entire financial position. Income flexibility is the third layer of defense. Relying on a single full-time salary leaves households most vulnerable when layoffs or downsizing strike. That's why building independent or supplementary income streams matters. A remote freelance skill, a tutoring service, a digital storefront, or even renting out extra space can all reduce dependence on one paycheck. These streams don't have to rival the main career financially. Their role is to keep cash flowing when base income stumbles. In 2025, digital platforms and remote work options make it easier than in the past to start something minimal and scale later. For resilience, it isn't the size of the side income that matters most. It's the fact that it exists at all. The fourth step is to avoid market timing and commit to systematic investing. Most people naturally try to outguess the market, waiting for crashes before buying, or selling in hopes of sidestepping downturns. In practice, even professionals rarely succeed at perfect timing. What works instead is dollar-cost averaging, making regular contributions into index funds or ETFs regardless of day-to-day movements. Automatic contributions enforce discipline, rebalancing stops portfolios from drifting, and the long-term effect is steady compounding. A household that invests regularly and resists reactive selling often outperforms those who leap in and out on emotion. In volatile years like 2025, this structure is especially important. It keeps investors from panicking at lows or missing rebounds. Taken together, these four steps act like tiers of protection. Liquidity is the safety net beneath everything else. Diversification spreads risk so that one bad market doesn't erase wealth. Income flexibility makes sure emergencies don't spiral into long-term instability. Discipline in investing prevents losses caused by our own reactions. No individual piece eliminates volatility, but the combination allows households to absorb shocks and move forward even when broader systems stumble. Making this tactical also means structuring how money is stored. Too often, people leave excess cash sitting in accounts earning below inflation interest, eroding value. Swapping those into high-yield savings or short CDs is low-effort protection. Too often, households put all savings into real estate or local equities, tying their fortunes to one geography. Expanding exposure to include international equities or global bond funds reduces that concentration risk. Too often, families rely entirely on wages from one employer without additional sources. Establishing even a small side service through digital platforms can cushion that dependency. Each adjustment is small in isolation, but meaningful in aggregate. It's also worth remembering that resilience isn't about building the perfect portfolio or income plan. It's about creating enough cushion so that when systems shake, households don't fall immediately into crisis. That distinction helps avoid paralysis caused by chasing flawless plans. If inflation rises above projections, the household with its cash in high-yield accounts still fares better than if the savings sat stagnant. If one stock market crashes, the diversified portfolio balances losses through exposure elsewhere. If a job is lost, the household with even a modest secondary income source can keep meeting obligations for longer. Resilience doesn't need perfection, just enough structure to shorten recovery time. A useful way to frame it is like an ordered checklist. Step 1. Secure liquidity through emergency savings in high-yield or short-term instruments. Step 2. Diversify across geographies and asset classes, with modest hedges in gold or other stabilizers. Step 3. Cultivate side or flexible income streams. Step 4. Automate investing with dollar-cost averaging and resist emotional trading. Each step builds on the last, and only when all are in place does resilience function reliably. In practice, applying these steps requires ongoing review. Interest rates shift, making one savings vehicle more attractive than another. Global markets move, creating imbalances that require rebalancing in portfolios. Personal circumstances evolve, requiring updated income strategies. Households that revisit their structure every 6 to 12 months keep from drifting into vulnerabilities they thought they had addressed. Building resilience isn't a one-time decision. It's a system of habits that adapts to conditions. The final point is psychological. Resilience offers stability not because it eliminates fear, but because it creates options. People who prepare with liquidity, diversification, income flexibility, and investing discipline do not need to panic when news headlines worsen. They can respond deliberately instead of reactively. This shift in mindset, moving from crisis-driven panic to structured decision-making, is often the greatest benefit of resilience, even beyond the financial math. Every household faces trade-offs: how much to save, where to allocate, what work to pursue, when to invest. In unstable times, those trade-offs feel sharper. But a structural approach gives individuals a framework to lean on and reduces reliance on guesswork. Instead of waiting for perfect conditions, they create conditions that protect them under nearly any environment. And as households think about resilience, there is a wider horizon to consider. The systems that supply our everyday goods are themselves under strain, from geopolitics, from climate shifts, from deliberate policy choices. Those pressures shape everything from the prices in your cart to the industries that remain profitable. Knowing how the flow of goods is changing is becoming just as important for personal resilience as knowing how to manage savings or investments. Supply chain diversification. Why your Amazon cart matters. Why does it matter where your packages come from in 2025? A few years ago, the question barely registered. If you hit by now, the only concern was whether the item would be cheap and arrive quickly. Today, every purchase is tied to a web of supply routes that cross oceans, border inspections, and choke points prone to risk. When those chains slow or break, the added costs move straight into your shopping cart. Consumer products no longer reflect only the cost to manufacture them. They now carry embedded costs from geopolitics, energy volatility, and climate shocks. Supply chains that once seemed invisible have become a significant driver of household financial strain. Electronics highlight this fragility. Phones, laptops, and appliances depend on components that cross multiple borders before assembly. US restrictions on advanced technology exports to China collide with Chinese curbs on rare earth supplies, raising costs not because of new features, but because of added friction in trade. A phone once priced at $1,000 now fetches more simply from policy barriers. The same pattern appears in clothing, home goods, and tools. A delay at one port or a bottleneck in one factory shifts prices weeks later on store shelves. Shoppers see price tags change without awareness that a missed shipment set it in motion. Climate instability amplifies these shocks. Floods that wash out transport routes in Asia or Latin America can delay deliveries across continents. A drought that weakens soybean harvests doesn't just affect farmers locally. It elevates global animal feed prices, raising the eventual cost of meat everywhere else. These were once rare disruptions, but they now recur regularly, making volatility feel like the new baseline. It's no longer just about globalization and efficiency, it's about fragility and resilience. Here lies the conflict. Consumers want the same variety of choices they've grown used to, at the lowest possible price. Yet companies can no longer prioritize the cheapest producer above all else. The real contest is not cost but security. Manufacturers increasingly choose suppliers and production bases that are more resilient, even if that means higher costs. This shift reflects a major strategy underway known as China Plus One, as companies reduce reliance on China by adding capacity elsewhere. Vietnam, Mexico, and other Southeast Asian nations have drawn new investment flows, becoming crucial nodes in diversified balance. For corporations, this is risk management. For consumers, it translates into higher prices but fewer empty shelves. What makes this shift notable is that supply chain diversification is not simply a matter for executive decision-makers. It now shapes personal finance. If companies and governments adapt their strategies, ordinary households must understand the implications because the consequences filter down into jobs, investments, and daily purchases. Concentration risk at the corporate level easily becomes budget risk at the household level. The electronics built on vulnerable inputs, or the groceries dependent on narrow distribution channels, can cause financial surprises for families who assumed stability. This is the new landscape. Resilience comes before efficiency, and that priority touches every role in the economy. For investors, knowing which sectors or firms spread sourcing across multiple nations is a practical way to reduce risk exposure. A company that still leans on one country for 80% of its materials may post impressive profits this quarter, but the next disruption can erase those gains and drag portfolios with it. Conversely, firms that emphasize diversification reveal stronger guards against shocks, and long-term investors have reason to reward that stability. For workers, the pattern matters just as much. Employment tied to organizations dependent on brittle global supply lines is riskier. A disruption can freeze salaries, trigger layoffs, or close plants outright. Meanwhile, firms that actively restructure, adding factories closer to consumers or balancing operations across continents, have greater stability. When evaluating career options, professionals have to look past the paycheck. A similar salary offered by a company with diversified operations could be a safer bet than a slightly higher salary at one with concentrated risk. Resilience in your employer's supply strategy is now a direct measure of your own income security. This rebalancing has shifted global industrial geography. Nations traditionally described only as low-cost bases are turning into central support pillars. Mexico, Vietnam, and select Southeast Asian economies are absorbing investments that once flowed exclusively to China. Their role is no longer peripheral. They act as pressure valves in a strained world economy, making their local economies more vital than ever. This is not a temporary trend. It reflects a structural recalibration of where production happens and how goods flow. For consumers, this reality forces new habits. Buying a shirt manufactured exclusively in one politically unstable region amounts to taking a position on that country's resilience. Filling your kitchen with electronics from long, concentrated supply tracks is effectively a bet that those tracks will hold. That doesn't mean refusing products from vulnerable regions altogether. It means being conscious of overexposure. Paying more for goods sourced through diversified origins is a form of insurance. The premium secures reliability instead of risking sudden scarcity or spikes. The logic mirrors what companies themselves are doing, but households can adopt it at their own scale. The same lens applies to investment. A simple filter is to check how companies or funds describe their supply situations in annual reports or disclosures. Businesses that mention redundancy, multiple factory zones, or diversified logistics aren't just displaying marketing language. They're signaling genuine risk management. Investors who reward those structural moves protect themselves by riding out disruptions with steadier holdings. The lesson is simple. Look past quarterly margin gains and examine how stability is built. Practical action matters here. First, consumers can check product origins when possible. Brands that advertise multi-region sourcing or transparent supply practices signal greater immunity to bottlenecks. Second, investors can favor businesses or ETFs that openly prioritize diversification in filings. A glance at supply chain notes is often more useful for risk assessment than tracking headlines. Both practices transfer corporate-level resilience into individual-level defense. This shift also brings intangible benefits, clarity about hidden exposures. Many households discovered during past shortages that their dependence on one country's production was greater than they realized. By paying attention now, consumers reduce vulnerability without waiting for the next disruption to reveal it. Supply chain diversification is therefore less about corporate buzzwords and more about personal buffers. Every step of the chain, from the goods in your cart to the wages in your account, is tied to whether producers can adapt or whether breakdowns ripple all the way to your household. Cheap goods with fragile origins may tempt in the short term, but stable goods sourced widely are the quiet protection that prevents surprise expenses. In a year defined by geopolitical shifts and recurring crises, what you order online is not just about price. It reflects a global system rebalancing. And if your next purchase signals how that system adapts, the same applies to where investment flows and where jobs remain stable. This is why consumer choices and career paths now carry more weight than before. They express how individuals position themselves against fragility. The broader significance is that these new hubs of production and resilience are not limited to corporate maps. They are shaping economic opportunities in entire regions. While the world's largest economies dominate headlines, smaller nations are becoming essential precisely because they offer balance and alternatives. Supply chain diversification exposes how easily power and wealth can shift when stability emerges outside today's familiar centers. And those shifts are creating new winners in the global economy. Emerging markets, the unexpected winners. While global attention fixates on the standoff between the US and China, a parallel story is playing out in 2025. Markets once viewed as peripheral are becoming critical growth centers. These emerging economies may lack vast militaries or deep financial reserves, but they hold three structural advantages that the larger powers struggle to maintain: younger populations, lower debt burdens, and a flexibility to adapt more quickly to change. For investors, workers, and entrepreneurs looking for new opportunities, these unexpected winners are reshaping where the future can be built. India is perhaps the clearest case. Its population now surpasses every other nation. But rather than straining under the weight of sheer numbers, India benefits from a demographic dividend. Millions of young citizens entering the workforce and moving into consumer classes. Unlike aging economies in the West or East Asia, this youth base creates a durable engine for decades of expansion. Alongside demographics, India's government has pushed a rapid digitalization agenda. Domestic payment systems are now used by hundreds of millions. E-commerce is accelerating, and manufacturing incentives pull in global supply chains. As multinationals seek to avoid relying solely on China, India's factories are winning orders that once traveled east. Outside investors have noticed. Capital is pouring into Indian infrastructure, logistics, and consumer markets. For households in developed countries wondering where the next growth wave originates, India represents one of the strongest bets on sustained consumption and innovation. Vietnam demonstrates the same shift through a different channel. The global search for diversified supply chains has powered what analysts describe as a China Plus One strategy, where corporations balance long-standing bases in China with production capacity elsewhere. Vietnam has emerged as a primary destination. Over the past few years, multinationals in electronics, textiles, and machinery have opened or expanded facilities there. This industrial expansion generates several reinforcing effects: jobs for a youthful workforce, expanding tax bases for public investment, and most importantly, rising household incomes that feed back into domestic consumption. Wage growth strengthens demand for local services, while exports grow steadily toward North America and Europe. Combined with low government debt and favorable demographics, Vietnam is well-positioned to benefit both from global trade realignment and from its own internal consumption cycle. Mexico illustrates another path. Geography has turned into its leading advantage. With supply chains steering closer to U.S. markets, Mexico's proximity allows companies to reduce shipping times and minimize exposure to international transit risks. American firms that struggled with tariffs, shipping costs, or delays in Asia have increasingly moved factories and suppliers across the southern border. Automotive production in particular has boomed, with electronics following closely behind. This nearshoring trend not only strengthens Mexican manufacturing, but also creates stronger links between Mexican industries and U.S. consumer demand. For investors, Mexican equity markets and manufacturing-focused funds provide direct access to this momentum. For households, supply chain security through Mexico means less vulnerability to long-distance disruptions. These three examples, India, Vietnam, and Mexico, highlight why emerging markets draw serious attention in 2025. They are not merely filling gaps created by global conflict, but actively constructing alternatives. Whereas developed economies contend with aging populations and higher debt, these countries carry structural tailwinds, favorable demographics, fiscal space, and strategic positioning. When corporations reduce dependence on China or grapple with fiscal headwinds in the US and Europe, they look toward markets like these for stability and efficiency. The shift is less about ideology than about practical necessity. For individuals aiming to capture some of this upside, participation does not require direct exposure to local exchanges or complex foreign strategies. In practice, three accessible entry points exist. Investors can use ETFs, mutual funds, or broader emerging market baskets to gain exposure to equities in countries like India, Vietnam, and Mexico without direct foreign brokerage accounts. These financial products bring global growth stories into ordinary retirement portfolios automatically. Workers with mobile skills can explore remote work arbitrage, earning salaries in dollars or euros while living temporarily in economies with lower costs. Living in Mexico City, Ho Chi Minh City, or Bangalore allows digital professionals to stretch their income further while connecting directly with expanding industries. Entrepreneurs can identify rising middle-class demand in emerging markets for goods and services that are already saturated in the West. In practice, this may mean launching small ventures connected to logistics, digital platforms, or consumer services that support the broader wave of industrial expansion. Together, these approaches show that benefiting from emerging market growth is practical for households at different scales. It does not require major capital outlays or relocation. It requires adaptability and awareness of where new demand is forming. Yet opportunity never comes without risk. Emerging markets experience volatility that wealthier nations often dampen. Policy shifts, regulatory uncertainty, weaker infrastructure, or political instability. Currency moves can also erode gains if not hedged properly. For that reason, financial advisors repeatedly caution against overexposure. A modest allocation in an India or Vietnam ETF can complement a portfolio, but relying too heavily on any single country increases vulnerability. The prudent model is diversification, approaching emerging markets as part of a balanced mix rather than as a core anchor. The central theme is that emerging economies increasingly matter not only for multinational strategy, but for household-level financial planning. 50 years ago, growth and wealth were overwhelmingly concentrated in the US, Europe, and later China. By 2025, those economies remain vital, but dynamism is shifting outward. Multinationals redirect factories. Capital shifts toward new hubs. Talent follows opportunities as infrastructure and industries grow. For citizens watching from developed economies, ignoring this redirection means missing one of the clearest stories of economic momentum available this decade. For viewers focused on practical finance, the question becomes simple. How do small, deliberate adjustments align with these trends? Checking if retirement portfolios include exposure to emerging markets, considering whether geography could enhance the value of a remote salary, and evaluating whether entrepreneurial skills could serve a rising middle class are all reasonable starting points. These steps require no dramatic reinvention. They demand attention and a willingness to look beyond conventional centers of power. As we step back, the through line across debt, political dysfunction, technology, climate, and shifting supply chains is that cycles are compressing. Once slow adjustments are now colliding, and opportunities are opening quickly outside the traditional pillars. Emerging markets illustrate that new centers of growth can appear quietly, reshape global balance, and pull in capital almost automatically. Understanding where those changes lead and how to position within them matters not just for corporations, but for everyday households navigating uncertainty. And it is in this compressed environment that the broader framework emerges. Multiple forces are now acting simultaneously, overlapping in ways that create both vulnerabilities and opportunities. Recognizing this layered reality sets the stage for what comes next. Not a question of whether these forces exist, but how their acceleration is reshaping the financial order itself. The five forces shaping 2025 aren't slowing down, they're converging faster. That speed makes resilience less about prediction and more about preparation. For viewers, three actions stand out. Protect liquidity with a 3 to 6 month emergency fund. Diversify across assets and geographies instead of relying on a single market. And build skills that pair AI with your field so you stay relevant as work changes. These steps don't eliminate risk, but they put control back in your hands. Comment below with one action you'll take this month. And if you found this useful, like and subscribe for more practical guides each week.